I find so many people enjoy listening to books on tape, Audible, that type of thing, and this book is not available in those means. So I'm going to take it upon myself to read the main contents of a book that I highly recommend. I give it away to so many people, but I want to give it away in this audio fashion. So some of my friends and colleagues and so forth can listen, read this great book, simple book that really is the infinite banking concept. But the author is not an infinite banking practitioner, authorized practitioner, but he's been selling life insurance for a very, very long time and totally understands this concept and explains it very simply. And so I hope you enjoy this book as much as I do. I'm going to be reading The Confessions of a CPA, the capital equivalent of life insurance. And so here we go. Oh, by Bryan S. Bloom. So let me get to the beginning of the book. What I believe. In everything we read, we ought to know what the author believes, what drives the author to write what they write. Let me start this book by telling you a little bit about what I believe financially. Over the course of our careers, our thoughts and beliefs are evolved as we gain experience. As a novice, we begin our careers by applying the theories and principles we learned in school to the real world. We note what works and what doesn't, and we eventually adjust our approach to fit the realities of life. For myself, finance has been a 40-year career, and I am still learning what works and what does not. But most important has been understanding what drives what I do and what motivates me to keep going. I have discovered that what I do is less important than why I do it. What describes a job, but why describes the motivation, conviction, and urgency. And it is the why that encapsulates a series of my beliefs that catapult me toward a real mission in life. I believe that what we are taught to be true ought to be true. I believe that we should challenge and test what is taught until we know that it is true. I believe that we should pay taxes once and only once on the money we earn. When we trade our time for someone else's dollars, that money is fair game for the administration to tax. That is earned income. I do not believe that what our money earns should be taxed ever. Unearned income should be off the radar screen of the IRS. I believe that we should receive from Social Security should not be taxed for two reasons. One, it is unearned income. And two, it has already been taxed once when it was earned income. I believe that wealth distribution is more important than wealth accumulation. Therefore, I believe that we should challenge the financial planning status quo and stop following each other off the financial cliff. I believe that people today are unknowingly and unnecessarily transferring hundreds of thousands of dollars of their wealth to financial institutions and to the government. I believe those transfers can be recaptured, recouped, and strategically redeployed to shift the possibility of financial success back to us. As these beliefs have developed and become foundational to my career, I have never had as much fun as I have today, helping people uncover these truths for themselves. That is why I've written this series of books, Confessions of a CPA, which expose some of the lessons I've learned the hard way in my career as I have sought to apply what I was taught. In book one, Confessions of a CPA, why what I was taught to be true has turned out not to be. I challenged some of the traditional approaches to implementing a financial plan and provided alternatives that lead to financial freedom. In book two, Confessions of a CPA, The Truth About Life Insurance. I examined strategic approaches to life insurance that leverage and unlock the economic value of life insurance during your lifetime, therefore increasing the value from other retirement assets. In this third book, Confessions of a CPA, The Capital Equivalent Value of Life Insurance, I take it all one step further and answer questions like, what if permanent life insurance was your only retirement asset? What would other assets have to be worth to provide the same retirement cash flows as your permanent life insurance policy, aka the capital equivalent value? How can you calculate the capital equivalent value of your permanent life insurance policy? Before we consider the living benefits of life insurance and its economic value in this book, we cannot ignore the traditional value of life insurance and what it can provide when life ends prematurely and all the hopes and dreams of your family vanish. My good friend John Butler told his story at a convention of financial professionals. And here is his story. My story goes back over 40 years, but who could see into the future 40 years? When my father retired from the Air Force in 1960, he was 47 years old and had to keep working as my sister and I were still in high school. He was a man who had graduated from the School of Hard Knocks in rural Illinois. He was orphaned early, went to Chaddock School for Boys in Quincy, Illinois, and on to the U.S. Army at the age of 18. Since he had lived through the Great Depression as a young man, he had learned that cash was what a person needed to make their way through life. He was always a saver and kept very close track of his money. I remember one incident when I found a $20 bill in our driveway, and it took him 3 days to figure out where he had spent the $20 bill that was missing from his wallet. I did get to keep the money after waiting out his memory, but my dad always had money for the things I needed. New shoes, clothes that fit, and for other unexpected demands for money that we all contend with as we operate our households. When I was still in junior high school, he taught me how to reconcile the family checkbook. I had no conception of what all the numbers meant. Nevertheless, we struggled through the checkbook reconciliation process. All of that leads us back to the retirement day from the Air Force. We moved to Fort Worth, Texas, and my dad set out to sell life insurance for a major life insurance company. His training through the life insurance company was on how to sell life insurance the life insurance company way. It is a tough business, and without today's tools and concept, it was a very tough business. His journey was brief, but he did believe in the product that he was selling. He believed in whole life insurance. He'd caught on to the theory of using life insurance to both save money and prepare for the unexpected events of life. For some reason, he purchased a whole life policy on my younger sister. The policy was for a face value of $10,000 with a premium of less than $100 per year. That was big money 45 years ago. He was getting her off to a good start by saving money in a whole life policy. We have learned that life consists of both expected and unexpected events. The unexpected happened. On October 8th, 1971, just north of Tonka, Illinois, when my sister's car was hit by an oncoming car that spun out of control. She was killed instantly, probably never even knowing what hit her. She was 21 years old, a senior in the nursing program at the University of Iowa. You know, when you leave this earth, you have no idea of what is coming for the people you leave behind, but you should know what to expect for yourself. My sister knew Jesus, and she left plenty of evidence. Of course, the life insurance policy paid the death benefit to my father. With the money suddenly becoming liquid, he invested in my startup grain elevator business in Illinois. That money grew and grew, providing a living for me to raise my family, giving my father a great deal of satisfaction. Seeing that money at work, a great deal of satisfaction seeing that money at work. It is possible to know it is impossible to know exactly how much money that 10,000 has made. It started a family business that ran grain elevators for 20 years. The money was then moved into farmland, where it has continued to provide income for my family. Today, the rate of return on the value of the farm exceeds the ability of any financial calculator. You could say that the rate of return on that $10,000 is almost infinite. That is just one story of what a life insurance policy has accomplished over more than 40 years. Who knows what the policies purchased today will do for the owners in the future? How will the money be used? For enjoyment, for starting a business, to save a business in a cash crunch, for a college education, or for retirement? In every case, it will make life better no matter what happens. Capital equivalent value defined. Financial assets can be very difficult to value. When we consider what something is worth, we often think of what its rate of return is. However, that can be very short-sighted for a number of reasons. First, when it comes to finding value in something, it is only worth what it can be traded for. Long ago, our economy was based on directly trading goods for goods or talents for goods. Today, we have an intermediary, money. Now we take our time and talents to someone who needs what we have to offer in order to generate a product or service that others value. Without our time and talents, they have nothing. As the process works backward, money is exchanged for that final product or service, some of which is kept by our employer, and some is given to us in exchange for our time and talents. So, what is our time and talent really worth? We may think of it as money as we received, but it is so much more. What benefit did those dollars get for you when you exchanged them for something you wanted or needed? This is the true value of the asset called your time and talent. Money is merely an intermediary. It's just money. The true value is based on benefits. Second, benefits can only be claimed as they are expressed in dollars. In other words, you can only spend dollars. You can't spend a rate of return. All of our fascination with rates of return is merely a distraction from what really is important. What benefit can be derived? A couple of simple questions frame it up for me. When I come to the end of my life, which will have been more important, the rate of return or the money I have available to spend? If given the choice, which would you choose? A $5 million nest egg that would provide you with $200,000 per year to live on in retirement, or a $3 million nest egg that would provide you with $100,000 per year tax exempt to live on in retirement. Those in pursuit of maximum accumulation of funds are going to be focused on the rate of return and would likely prefer the $5 million nest egg. This is likely the situation because they are focused only on accumulation of money and not on the distribution of wealth. Permanent life insurance happens to be one of the most difficult assets to value because its benefits are more complex and cannot be easily shown as a straightforward sum of money like other assets. So, how do we put a true value on life insurance? Do we merely concentrate on the accumulation of its cash values? Do we emphasize the value of death benefits, as in John's story? Or is there a way to value both at the same time as it relates to you as the owner of the asset? The capital equivalent value of life insurance provides the answer. Capital equivalent value is defined as the sum of money a financial asset would have to grow to in order to provide the same benefit of another financial asset, like a permanent life insurance policy. Therefore, capital equivalent value is a benefit-based calculation. In the case of a difficult to value asset like permanent life insurance, capital equivalent value shows what any other asset would need to accumulate to in order to provide the same benefits that the life insurance policy provides. Mount Everest. Mount Everest has the distinction of being the tallest mountain in the world. It stands at 29,035 feet. Its top is the most desirous summit of all mountain climbers. Story after story, documentary after documentary, the quest for the top is filmed and chronicled. But is the summit really the goal? A few startling statistics from 1924 to August 2015, August 2015, there have been 4,093 individual people who have stood on the summit of Mount Everest. Some have paid as much as 85,000 in their final quest of the top. A total of 282 individuals have died in their pursuit. The death to summit ratio is almost 7%. This is an important number to remember as you read ahead. Out of every 100 people that make it to the top, 7 die. More startling is the statistic that 56% of all the deaths that occur on Mount Everest occurred after they had made it to the summit. That is right. There are 157 people who are counted on in both statistics. Those that succeeded made it to the summit, and those that failed died on the mountain. So did they succeed or fail? Much is the same when it comes to financial planning. What is your goal? Is it to accumulate the biggest number, or is your goal to get down the mountain safely? Which would you rather have? $5 million reaching the top, knowing that if you withdrew more than 4% of the nest egg, which is $200,000, you had an unacceptable probability of running out of money, or getting 60% of the way to the top, 3 million, but knowing that your probability of running out of money was low, even when withdrawing perhaps even more, after tax, 180,000. It has everything to do with what you are concentrating on. The bigger number, the better rate of return, or the benefits that can be achieved if you set your sights on your distributions. On the way up the retirement mountain, are you minimizing your taxes as much as possible so you can accumulate more? Or are you paying your fair share as you climb so when you descend, you don't have a tax burden hanging around your neck? Do you believe, as I do, that we should only be required to pay taxes once, only on the money we earn and not on the money that our money earns? It makes a significant difference in your retirement years. Compound interest. The more I study how wealth works, the more I'm convinced that Albert Einstein was right when he said, compound interest is the eighth wonder of the world. He who understands it earns it. He was really onto something here. However, he would have been more accurate had he added, as long as he doesn't spend it. Perhaps he should have said, uninterrupted compound interest is the eighth wonder of the world. He who understands it earns it and keeps it. I was always taught to understand and respect the exponential curve that reveals this miracle. Indeed, a dollar earning a dime is not just $1.10. It is the continual earning power of not just the dollar, but also of all the dimes in the earning cycle over and over again. There is more power in the dimes accumulating and earning than in the original dollar earning. The cycle continues as long as it is not interrupted. This is the key to financial freedom. Just don't spend your money, ever. Well, that is just downright silly. We save money in order to spend money. But if you do, the miracle disappears. If you save $5,000 per year for 30 years, earning 5%, and don't spend it, you would have over 300,000. However, if you spent your savings every 5 years, in 30 years, you would have slightly more than 25,000. Is the miracle gone? No, it has merely been transferred to someone else. By not understanding this concept, we unknowingly and unnecessarily transfer the miracle to universities when you pay tuition from your compounding account, the IRS when you pay your income taxes from your compounding account, financial institutions when you pay your account fees from your compounding account, the car dealership when you pay for your car from your compounding account, your local grocer when you pay your groceries from your compounding account. What? My groceries? Yes, a very subtle financial principle that many of us never realize is that everything we purchase, we finance. Everything. even when we pay cash. When you borrow money from the bank to purchase your car, you are borrowing from the bank and paying interest now. But when you pay cash for your car or even groceries, you are borrowing your future by interrupting and compounding the compounding interest. You are just going to have that much less during your retirement. More on this important concept later. Let's get real. You must spend money. Perhaps the best advice is to give that when you spend money on something you can afford from your paycheck, pay cash. But when you want to spend money on something that won't be covered by your paycheck, borrow the funds. Plan on paying it back from within the budget from future paychecks. Never spend your savings or investments, interrupting the compounding. This first became evident to me a few years after I had begun to develop a compounding investment strategy of my own. There was a year early on in which the taxes due on the growth of my investment account exceeded my ability to pay taxes out of pocket. I had the money to pay the taxes, but it was contained in the investments. In order to pay my taxes that year, I needed to withdraw the money out of the investments to send to the IRS. There are two problems here. First, the taxes we pay are either a direct reduction of our current lifestyle, paying the taxes out of our pocket, or a direct reduction of our future lifestyle. Let's say the tax was $1,000. The choice to pay it out of pocket is to reduce my checking account balance by $1,000. This means I can't spend that money on anything else today and will never earn another dime for me again, a current and future lifestyle reduction. If I didn't have enough money in the checkbook, I would need to redeem some of my investments to pay the tax. Investments that represent money I was planning to spend on my future lifestyle. Either way, the IRS intrudes on my life when they tax the money on my money earns. Let me say that again. Either way, the IRS intrudes on my life when they tax the money my money earns. Today, when I reduce my future lifestyle, stop that one again too. Second, when I reduce my future lifestyle, the reduction is compounded. It is compounded because in this example, not only will my withdrawn investment never earn a dime again, but it has lost its potential to compound. In this example, what did $1,000 tax cost my future lifestyle? It cost the $1,000 tax payment and all the interest that the 1,000 plus its earnings would have earned. If this tax were due when I was 40 years of age and I could have earned 5% on my investment account, the $1,000 withdrawal cost my future lifestyle $3,386 at the retirement age of 65. As soon as you withdraw money from a compounding account, the compounding is reset. The new compound interest curve is flattened and longer. The second time I noticed this happening was when my daughters wanted to go to college. I was always taught to save and invest for college because you will never be able to pay for it out of your budget, your current lifestyle. So I did. The result was a retirement compound interest curve that was flatter and longer. If I add up the cost of the tax and the tuitions paid in this simple example, they do not account for the reduction of my account compound interest curve from where I should have been and where I actually was. The difference between what I spent and what I was supposed to have were light years apart. You can see the effect of interrupting the compound interest. And he shows a graph in the book where he interrupted somewhere around year 18. He started taking the money out. And at that point, he had about 150, just short of 150,000, drained it out for the taxes and for college education. He had to start over, say around year 18, and he started to accumulate. And at the end of 30 years, it looks like he has about 75,000 in this compounding interest account, and he should have had about 325,000. The logical conclusion is that Einstein was wrong. Compound interest is not the eighth wonder of the world, but Einstein can't be wrong. Everything we purchase, we finance. Many fathers launch their children into adulthood with two lessons. One, never enter into debt because then you will pay interest. Two, never pay more for something than it is worth, which of course you will if you have to pay interest. Two ways of saying the same thing, but that was dad. I was always taught to save before I spent anything. Always save, then spend. Never the other way around. So that is what I did. I'd save for a car, then I'd buy the car. The cost of this approach to me was the delayed satisfaction of owning my first car. The small price to pay to implement such a sound financial strategy, right? Meanwhile, my friends who couldn't stave off the purchase of their first car borrowed the money and paid it back. Just as the first car was paid off, they started the cycle all over again. Who was better off? According to dad, I was better off because I never paid interest. In reality, my friends and I were both at the same point at the end of every purchase cycle, and that is zero. I would save, then spend my savings back to zero, while my friends borrowed and worked their way back up to zero by paying off their debts. We were in the same position, zero. What happened? The lesson to be learned is that there really is no difference between saving and spending, or borrowing and paying back. The lending position is easy to understand. You pay interest. The saving position is a bit more subtle. When you spend what you save, you don't earn interest. Either way, paying interest or not receiving interest is the cost of the purchase. Everything we purchase, we finance. We just don't realize it. And it doesn't matter whether it's a loan from the bank to purchase a car or a loan from our future lifestyle to purchase a bag of groceries. Both have a cost beyond the cost of the car or the groceries themselves. The only difference is when the cost is felt. In the case of bank financing, the cost is felt while you're making the payments. In the case of paying cash, the cost isn't felt until 40 years later when you have less to spend during your retirement years. I understand this may all seem small and inconsequential, but over the years, understanding how to purchase common goods now can add up to a significantly higher quality of life for you in retirement. Despite what many of us learned, it is only when combining the saving and borrowing financial strategies that true economic value emerges. Saving and borrowing. The miracle of compound interest is unachievable whenever you spend what you have saved and invested. But if everything we purchase has an ultimate cost over and above the sticker price, because everything we purchase we finance, is there a better way? Yes. We need to learn how to combine saving and borrowing at the same time. How can we do this? Leave what you have saved and invested to compound uninterrupted and spend someone else's money when you want to purchase something. This will always work when the cost of borrowing is less than the gain on your savings and investments. That is the concept of arbitrage. And here's a quick definition. Arbitrage is the simultaneous purchase and sale of an asset, aka cash, to profit from a difference in the price, aka interest rates. It is the trade that profits by exploiting the price differences of identical or similar financial instruments on different markets, aka savings markets and debt markets, or in different forms. What if interest rates are inverted? What if the interest rate cost of borrowing is more than the rate of your savings or investments? Over a short period of time, it depends on the sheer volume of the actual dollars. The larger your savings and investment balance and the smaller amount of your loan outstanding, you will still gain a larger number of dollars in your savings and investments than dollars you will have to pay to borrow money. Here's an example. Let's suppose you are 50 years old with a $200,000 investment balance and want to purchase a $50,000 car. Since you have the money, you may likely choose to pay cash because you don't want to have to pay interest to pay more for something that it is worth. Let's examine this decision. When you remove the 50,000 from your investment account, will you permanently remove that money? Over time, some will likely return the 50,000 removed from the account, but few will restore the gain that money missed earning because it was out of the account. And none will restore what the gain would have gained had it never been removed from the account in the first place, which is the value of the compounding. Here is what has actually cost you to purchase the $50,000 vehicle from your savings or investment account. I am assuming you are earning 5% in the savings or investment account. Over the first year, that vehicle actually cost you $50,000 purchase price plus the $2,500 gains you did not earn in your investment account, which equals a $52,500 actual cost of your car. Over the first 5 years, that vehicle actually cost you the $50,000 to purchase plus $13,814 gains you did not earn in your investment accounts, which equals the $63,814 actual cost of your car. Why is this such an odd amount? Because it reflects not only the gain on the 50,000 investment that is no longer in account, but also on the gain of the gains that are no longer in the account. What is the cost to your retirement? If you retire at age 65, the vehicle cost you the 50,000 plus $50,946 gain you did not earn in your investment account, which equals to $103,946 actual cost to your retirement nest egg, funds not available to your retirement lifestyle. What is the cost of this vehicle to your estate, to your heirs? If you live to your life expectancy of 85, the $50,000 car purchase plus $225,800 in gains you did not earn in your investment account equals $275,800 actual cost of your car to your heirs, funds they will never inherit. And that is just one vehicle. What if you purchase a new car every 5 years? The cost of driving to work, where you may be building your retirement nest egg through the 401k, is easily over $1 million. That part is worth reading again, so I will. The cost of driving to work, where you may be building your retirement nest egg through your 401k, is easily costing you over $1 million. Now, what if you could purchase the vehicles without interrupting the compounding of your savings or investment account? By combining the concept of saving and borrowing together, you will begin to piece together the answer. Now, most financial institutions will accept your compounding account balance as collateral to borrow their money. Your money continues to grow. You just can't spend it while it's being held as collateral. With near perfect collateral, such as your actual account, banks will likely extend to you the money at their best rates. Does this sound like the way you purchased your home? It should, because this is exactly the way we obtained a mortgage to purchase a house. The personal asset used as collateral is your house. People do this every day. Why don't we do this with everything else? We don't because we think we can, quote unquote, afford it to pay cash, so that must be best. So rather than pledge that cash as collateral, we give it up. As described above, that is an unaffordable transaction, but we do it every day. In my book, Confessions of a CPA, The Truth About Life Insurance, I describe the pros and cons of many of the accounts that a financial institution will accept as collateral. That book shows that a permanent life insurance contract is the perfect financial instrument to pledge as collateral back to the life insurance company in order to borrow their money. Here's how it works. Look at your permanent life insurance contract as a financial institution unto itself. The first step is to purchase a contract and fund it. Very important information right here. Much like a new bank needing to capitalize itself, aka establish a serious balance of funds from which to lend, you need to purchase a permanent life insurance contract that you fund to a serious balance of funds against which to borrow. When dividends are paid, the life insurance company will provide you with several options regarding how to apply or accept those dividends. Choose to have your dividends purchase paid up additions, which is additional life insurance, micro amounts of life insurance. This choice allows both your cash values to compound and your death benefits to grow. Now that you have built up sufficient cash values to pledge as collateral to borrow funds from the life insurance company, you can begin to use your new leverage to fund your major purchases. Most of the time, you can request a loan from the life insurance company with a single sheet of paper or phone call. No applications, no credit checks, no credit scores, no financial disclosures, and no waiting time. Funds are transferred to your checking account the day after you make the request. Because these funds represent a loan from the life insurance company, they are not taxable income to you. This is much like your mortgage loan, which was not taxable income to you when you purchased your home with borrowed funds. Other than the interest rate, the terms of the loan are up to you. As long as you have enough collateral, you can pay back your loan whenever you want, or never at all. If you die with the loan outstanding, the principal of the loan outstanding, and any interest that wasn't paid will be recovered from your death benefit that would otherwise be paid to your heirs. Literally, your dead self is repaying the loan. What about retirement? In retirement, you choose to never repay the outstanding loan. Your eventual death benefit will cover what you borrowed to finance your retirement. Let's look at an example. Assume you're a 55-year-old couple who can afford to pay $100,000 each per year for 10 years towards your retirement, either from your cash flows or by redirecting other investment balances. That represents a total commitment of $1 million toward your retirement. If you are wondering where you can find 100,000 per year, remember that the kids may be out of college and you are no longer paying tuition, room, board expenses. Those can be redirected. If they have sucked you dry of all your retirement dollars, you have to start saving in a big way at this point anyway, or you won't retire when you want. After all, in the years prior to college, you wondered how you would pay for college, but you did it anyways. If your funding ability is not 100,000 per year, or you would like more cash flow in retirement, all the numbers in this example are scalable up or down. If you are younger, you have the ability to start earlier, which means you will be able to pay at a lower annual commitment rate in order to accomplish what this 55-year-old couple will accomplish. Now, immediately upon signing the permanent life insurance contracts, this couple will each begin with approximately 800 to 950,000 of death benefits, depending on their health and whether they are male or female. When they retire 10 years later, they will have accumulated approximately $1,082,000 of cash value. That should not seem like a lot, after all. Your total deposits were $1 million. However, remember the Mount Everest story. Would you rather have a bigger nest egg or more retirement cash flow? Keep reading. As the couple begins the retirement years at age 66, to coincide with approximately the beginning of their Social Security payouts, they can begin to take loans from the insurance company that will be recovered from their ultimate death benefits at the rate of approximately $70,000 per year. One of the requirements of the tax laws that define life insurance, TAMRA and DEFRA, is that the death benefits of a life insurance contract must increase in value or will have to take the annual dividends as taxable income. To avoid this taxable event, our choice is to reinvest the dividends as paid up additions, thereby increasing both the cash values as well as the death benefits. Because this couple chose this method of receiving dividends, their combined death benefits have grown from 1.8 million in the first year to now over $2 million 10 years later. As they take loans to finance their retirement, the chart below represents the combined life insurance contracts. And all I can say is that they were taken out for 30 years. They were taken out the 70,000 and by year 30, of course, that makes, I think they started in year 10, that's 1.4 million. And then they have a remaining collateral of cash value of 338,000, and they have a death benefit of 905,000. So I'm going to read some of, well, let's just bypass that. You must make sure that there is always enough collateral to cover the loan outstanding. Remember, it is the collateral that gives you the permission to borrow from your life insurance company. If you violate the terms of the collateral requirements, the life insurance company will give you two choices. Begin shoring up your collateral by paying the interest due on the cumulative loans outstanding each year, or cancel the life insurance contract and the loan outstanding, keep the cash value that represents the remaining collateral after the payment of the loan. Neither solution is advantageous to you. Because you no longer have any collateral capacity for additional loans, you will cease to receive the annual loan distributions and will need to start paying the interest. If you cancel the life insurance contract, all of the previous loans up to what you have paid in the form of premiums remain tax exempt. They represent a return of your premium, but the excess over your cumulative premiums is no longer considered loan proceeds. They are recategorized by the Internal Revenue Service's deemed distributions and reportable as taxable income in the year you cancel the life insurance contract. Life insurance company doesn't care which you choose. They are in the perfect position. The loan they have extended to you is likely at market interest rates and represents an adequate financial investment, or they can deem the cash value used as collateral and reinvest it at market interest rates. A well-designed life insurance contract will include annual loan distributions that extend for 5 years past your life expectancies and will provide you with a death benefit for at least age 100. Your specific family history may dictate longer periods. It is extremely important to work with a life insurance professional who understands these concepts and will work with you to monitor the contract's performance on an annual basis. You may need to make adjustments along the way. Don't let any of that scare you. I can tell you right now, these are specifically designed and engineered to never get you into a taxable situation. So that's in his book. I just wanted to throw out that caveat. Do not worry. There's plenty to explain and understand and give you comfort. Why life insurance works. Life insurance is the best asset to use in this strategy because of what the Internal Revenue Code provides in regard to its taxation. The Deficit Reduction Act of 1984, or DEFRA, and the Technical and Miscellaneous Revenue Act of 1988, TAMRA, together gave a new definition to what would be considered a life insurance contract and what would be considered an annuity. The laws give preferential tax treatment to life insurance over annuities. The limits of DEFRA and TAMRA must be adhered to, or what you thought would be tax exempt life insurance will be merely tax deferred annuities. The permanent life insurance provisions in the Internal Revenue Code are U.S. Code 7702. This section defines what qualifies as a life insurance contract and what does not. This is important because only life insurance contracts receive the most favorable tax treatment. U.S. Code 101. This section defines certain death benefits paid at death that are exempt from income taxation. In U.S. Code 101G, this section specifically exempts from income taxation certain accelerated death benefits paid during a person's life. And U.S. Code 72E. This section differentiates between an annuity, which is taxable income, and a life insurance contract, tax exempt income. I can tell you, I'm going to just another caveat. So many of the practitioners and life insurance agents out there are selling annuities, and those are all taxable income. They're going to guarantee income, but they're putting you right back in that same boat where you don't know what the tax rates are going to be when you start to turn on that flow of income. Any loan distributions for which a portion of the value of the contract is assigned is not received as an annuity and consequently tax exempt. So any loans that you take out from your life insurance company will never be considered taxable. Any dividend earned is not included in gross income to the extent the dividend is retained by the insurer as a premium for the purpose of purchasing paid up additions with the dividends. So we always design these policies to have the dividends roll back into the policy to buy more micro amounts of insurance and avoiding any kind of taxable event. This section, US Code 72E5, this section excludes all life insurance contracts issued prior to August 13th, 1982 from provisions of Code Section 72E. This is what is commonly known as the grandfather clause, not subjecting prior life insurance contracts to the constraints put on life insurance contracts. US Code 86. This section provides for the second taxation of Social Security and Tier 1 railroad retirement benefits because of other taxable income. We'll talk about this more in the future of the book and how we get potentially taxed on our Social Security and through the vehicle of life insurance, the way that we're talking about it here will help you avoid having any of the Social Security or Medicare benefits costing you more, right? Meaning you're going to get taxed on your Social Security or your cost of your Medicare premiums would be higher if you showed income. As a requirement of TAMRA, the United States Government Accounting Office was to report to Congress regarding the effectiveness of revised tax treatment of life insurance in the policy justifications for and the practical implications of the present treatment of earnings on the cash surrender value of life insurance and annuity contracts in light of the Tax Reform Act of 1986. In their report, they made the following observations. The basic purpose of life insurance is to provide protection against income loss to beneficiaries who are often dependents of the insured. The death of the insured terminates the whole life insurance policy. The accumulated interest income or inside buildup in a life insurance policy is not taxed when paid to the beneficiary on the death of the insured. Death benefits have been exempt from federal income tax on welfare and humanitarian grounds because they are usually paid to a family that has suffered the loss of a primary earner. If a policyholder borrows the inside buildup from his or her life insurance policy, the amount borrowed is considered a transfer of capital, not a realization of income, and therefore is not subject to taxation. This reasoning is in accord with tax policy on other types of loans, such as consumer loans or home mortgages. These loans are merely transfers of capital or savings from one person to another through a financial intermediary. The ability to borrow against a life insurance policy means that the interest income that is supposed to be building up to fund death benefits can instead be a source of untaxed current income. If the loans are not repaid, the inside buildup will never be taxed. Death benefits will be simply reduced by the amount of the loan. Thus, policyholders have the use of tax-free income for purposes other than insurance at the expense of reduced death benefits for their beneficiaries. Page 27 of the report. You may be thinking that life insurance strategy has passed you by because of your age. You may be thinking that now that the children are grown and on their own, you don't need life insurance. You may not need life insurance, but you should want the life insurance tax code, what the life insurance tax codes does for you. Let me say that again. You may not need life insurance, but you should want what the life insurance tax code does for you. How life insurance works. In a traditional sense, life insurance isn't really life insurance. It's death insurance. It isn't really for you to benefit from, but it is for those you care about to benefit from. Life insurance provides cash at just the time when cash is needed most. when the unexpected happens too soon. However, most life insurance policies never pay this ultimate death benefit. Sometimes it is designed in such a way that it will probably never pay the death benefit. The premium is structured in such a way that you are either plan to or are forced to discontinue a life insurance contract after a certain period of time. This is term insurance they're talking about. Either the premium is no longer affordable, or you have reached an age and a stage in life that you don't need the coverage anymore. Other times, a life insurance contract is provided to a certain group of individuals. If you are no longer a member of the group, you are no longer eligible to keep paying the premiums and the policy is terminated. This often happens when we terminate our employment. What if your next employer doesn't offer group life insurance contract? What if this is your final employer prior to your retirement? Most group life insurance contracts are not portable. You can't take the contract with you, and if your health has deteriorated by the time you are no longer eligible for a group plan, you may not be eligible to purchase an individual plan. Less than 2% of all life insurance contracts ever pay a death benefit. The greatest financial transfer during your lifetime could very well be your life insurance policy. So be careful to implement a strategy that uses life insurance carefully. Find a financial professional who is skilled at using life insurance policy as described and ask for assistance. When a life insurance policy does not pay a death benefit, the premiums paid are not returned to you. In addition, what you could have otherwise earned in that money is also lost forever. When you terminate your life insurance, does the life insurance company return your premiums because you did not die? No. How long do they keep your premiums? Forever. The financial institutions understand the secret of the miracle of compound interest. Minimize the number of interruptions to the compounding of the money. When you don't die on time, you transfer the miracle of all that money to them. How could life insurance be the greatest financial transfer of your life? Think about it. You are 25 years old. You and your spouse decide that to support the family you plan on having, you need 1 million of death benefits between now and when you retire. But then your assets can provide what your survivors need. But money is tight, so you opt for the least expensive option, a series of 10-year term life insurance policies that you choose to renew every 10 years when the premium is scheduled to go up. At age 25, you are at the zenith of health and obtain a 10-year level premium term life insurance policy with a waiver of premium in the case of disability for $27.25 per month for 10 years. Total expenditure is 120 months times the 27.25, which equals $3,270. Actual cost, because you could have accumulated this amount at interest if you did not give it up to the insurance company. You not only spent the $3,270, but also transferred what could have earned and what the interest you did not earn could have earned, assuming an interest rate of 5%. A lifetime cost of $48,725 because the life insurance did not return any of those premiums or the interest they earned on your money. You have lost that money for a lifetime. That is just the first 10-year policy. What if you continued this strategy and purchased a new 10-year policy every 100 years to replace the previous one? The lifetime expenditure for your policy between the ages of 35 and 45 would be $42,254. From 45 to 55, it would be $73,162. And between 55 and 65, it would be $144,759. Your plan worked. You have made it to retirement. You've accumulated enough assets to finally replace yourself, and you no longer need any death insurance. Your total lifetime expenditures is $308,900. This could be the largest single financial transfer you will likely ever make in your lifetime. Now, please do not read this and think that you should not purchase term life insurance. You should have an equal level of life insurance death benefits that equals your human life value. You are the financial engine that runs your family. How would your family's financial future be financed if you were no longer around? Whatever amount of money that would take is your human life value. Whatever amount of money that would take is your human life value. You must have an equal amount to this until your assets can replace your human life value. Most people can only afford the term life insurance costs and must opt for this method. Fewer can afford the larger financial outlays required for a permanent life insurance policy. It is precisely these vast sums of money that make a life insurance company tick. Without having to pay death benefits for 98% of the policies, life insurance companies are profitable. But what about the 2% that do wind up transferring millions of dollars out of hands of the insurance companies into the hands of the beneficiaries of individuals who die prematurely? The whole premise falls apart if there are too many premature deaths that pay these death benefits. That is why the federal government requires that life insurance companies set aside a certain amount of money called reserves in case there aren't enough people paying $27.25 per month to cover the $1 million claim. Where do the reserves come from? Over time, they can come from enough 27.25s per month from premium payers. But what if there are not enough? Enter equity partners of the life insurance company. That is you and me when we purchase overfunded permanent life insurance policies. That same 25-year-old who purchased a series of 10-year term policies could have purchased an overfunded permanent life insurance policy for monthly premium of $1,769 for the next 480 months. That would be a total expenditure of over $849,000 for a permanent death benefit that would provide $1 million or more to his beneficiaries at his death. He doesn't need to die on time. The policy is designed to pay a death benefit whenever he dies, not according to some predetermined schedule. A quick look would indicate that he's going to trade $1,769 for $1 million of death benefits available from day one of his policy. Over the 480-month period of time, he will pay the $849,000 in monthly installments at $1,769 per month. Now, trading $849,000 over this period of time for $1 million doesn't seem like a good deal on the surface, but is far better than having no death benefit at all if he doesn't die by age 65. That's zero benefit for a total cost of $308,900. Now, you might say, why would he ever do this when there are better ways to invest your money? He would do this because the benefit is not the $1 million for an investment of $849. It is actually far greater, as I will discuss later. And you might ask, why would the insurance company ever do this if the return is far greater for the policyholder? The reason is because the insurance company needs equity partners to accumulate enough reserves to sell their term life insurance policies. These term policies represent their overall profit because the company pays out the death benefit on them only 2% of the time, but keeps the premiums forever. And to reward the policyholder of overpaid permanent life insurance for essentially providing them with the equity they need for the business model to work, the life insurance company returns a portion of the profits to the policyholders in the form of a dividend. So the company and the policyholder both receive a return on the investment. Both parties win. Additionally, the policyholder happens to receive a far greater benefit than the dividend. And that is what I am building up to in this book. Enter the Internal Revenue Code. According to the provisions of Tamara and DEFRA, the IRC, or the Internal Revenue Code, mandates that either the dividends of a life insurance policy must be paid out to the owners taxable, or if kept in the policy cash values to compound tax deferred, the death benefits have to go up each and every year. By the 40th year in our example, the 25-year-old, his death benefit would have grown from 1 million to almost 4.2 million. According to the IRC, your death benefits are exempt from income taxes. Your dividends accumulate tax deferred. and you can extract wealth from your life insurance contract as loans against the ultimate death benefits. The proceeds from a loan of any type are tax exempt. Think back to when you purchased your car and financed 20,000 of the purchase from your local bank. Did you have to report 20,000 as taxable income in your income tax return? No. Loan proceeds are tax exempt. This isn't rocket science. It really is that simple. You just need a life insurance professional that understands how to construct and administer such a life insurance contract. Mountain climbing guides are skilled not only in getting you up the mountain, they are skilled at getting you off the mountain as well. Certain life insurance, oh, certain life insurance professionals have these same skills as you face the financial mountain. If you wonder if your financial advisor or life insurance professional has these skills, just ask them for the exit strategy they have planned for you. Likely, their plan is only to get you up the mountain, not off the mountain. Who has your exit strategy in mind? Just ask. You have a right to know. Even this 25-year-old in this example should be asking what his exit strategy is. Is your financial advisor still trying to crack the code? Get one who knows it is in the code. What properly designed life insurance looks like. The properly designed life insurance contract has all the hallmarks of what the Internal Revenue Code allows when it comes to life insurance. One, as much premium for as little death benefit as possible. Yeah, I'll say that again. You want to get as much premium in for as little death benefit as possible. If you need more on a temporary basis, purchase some term insurance to fill the gap. Maximize the frequency and the volume of the premiums. So how quickly you get it in and the volumes of the premium the IRC will allow. In other words, get the money in as fast as you can, but stay within the IRC rules. Choose to reinvest the dividends as paid up additions so that they increase your cash values and death benefits the older you get. Properly designed life insurance contracts take the advantage of all the opportunities the life insurance company will allow. One, payment of premium by the life insurance company in the case of disability. You want the plan to complete itself if you can't complete it because of a disability. Two, if you can't purchase your total human life value in the form of permanent overfunded life insurance, then the policy ought to allow you to purchase more in the future at your health today. Three, in the event of a prolonged illness, the policy ought to allow you to use an accelerated option of obtaining death benefits. The properly designed life insurance contract will be provided by a life insurance company that is a mutual company, not a stock company. A mutual company exists for the benefit of the policyholders and consequently manages their profitability for the long term. The stock company exists for the benefit of the stockholders and consequently manages their profitability over the short run in the current stock price. I only work with mutual insurance companies. Number two is a non-direct recognition company. This has to do with dividends. A direct recognition company directly recognizes loans outstanding when they grant their dividends. Policies without loans outstanding receive a greater share of the company dividend. A non-direct recognition company doesn't recognize outstanding loans when they grant their dividends. Therefore, the company pays the same dividend regardless of any loans outstanding. I only use non-direct recognition companies. Sets their loan interest, this is number three, sets their loan interest rate according to a well-recognized bond index. This removes the risk of excessive loan rates at the discretion of the company. Loan interest rates will be market-based, not insurance company board-based. Four is well rated by Standard & Poor's, AM Best, and Moody's. As a result, you will receive a competitive set of benefits as compared to an alternative investment that provides the same economic value. Capital equivalent value. Permanent life insurance is a hard to value asset. That means that it is That means that its value can only be estimated when compared to the value of another asset that would provide equal benefits. The other asset could be any financial asset, such as stocks, bonds, mutual funds, gold, silver, real estate, etc. Comparing life insurance to other assets leads us back to the capital equivalent value. As you remember from chapter 1, the capital equivalent value of an asset was defined as the sum of money a financial asset would have to grow to in order to provide the same benefit of another financial asset, such as a permanent life insurance policy in this case. Can the asset achieve the capital equivalent? If not, the permanent life insurance policy is the better investment option. Now, let's take a look at how to apply a capital equivalent calculation to a typical life scenario, real life scenario. A hypothetical 55-year-old individual in good health wants to make an investment. For any number of reasons, this person is starting from scratch and needs to save at an accelerated rate in order to retire in 10 years. And they will be able to invest $100,000 per year put towards their retirement. What is the best financial asset for them to invest in? First, since the hard to value asset to consider is permanent life insurance, we need to identify what benefits the permanent life insurance policy in question would provide. And remember, it is more than the death benefits. A significant portion of the value of the permanent life insurance policy lies in the ability to use the cash value, the investment plus dividends, as collateral to borrow from the death benefits. In other words, the death benefits can be accessed during the lifetime of the insured without having to die, and because the cash flow from the life insurance policy will be received as a loan, it is not taxable by the Internal Revenue Service as income. Current interest rates directly influence the interest rate a company charges for a loan and the dividends they declare. In these examples, I'm using year 2017 interest rates. Today, a life insurance policy can provide $67,000 per year or $1.675 million total from age 66 to 90, a 25-year period. Tax exempt when taken as a loan against the death benefit. Why 66 to 90? Because 66 is when Social Security begins for many Americans. 90 is 5 years longer than normal life expectancy. We always want to plan for more life than less life. And a residual death benefit of 1,039,000 if death at the age of 85, normal life expectancy. 662,000 if death at age 90, 5 years past life expectancy, or 184,000 if death at age 100, 15 years past life expectancy. You always want a residual death benefit when death occurs. To summarize this investment plan, the total investment of 1 million, which is 10 deposits of 100,000, distributions during life is 1,675,000, which is 25 loan distributions of 67,000. So let me say that again. You put in 1 million during your life, the distributions add up to 1,675,000. At death, you have 662,000 in death benefits at age 90. So total distributions were 2,337,000. Net lifetime gain is 1,337,000. Income tax exempt. Now that we have determined the inputs, 100,000 per year for 10 years, and outputs, 67,000 per year for 25 years, plus the death benefit of the permanent life insurance policy in question, we need to determine the financial rate of distribution from the alternative investment that would provide the same outputs. This is the last number we need in order to calculate what value an alternative investment would need to achieve after 10 years in order to generate the same value that the permanent life insurance policy provides. This value is the capital equivalent. 4% is the generally accepted financial rate of distribution, but that rate is actively challenged by various financial professionals, otherwise known as the 4% rule. It has been derived by calculating the probability of running out of money over a lifetime. In essence, it says there is a 96% chance of running out of money before 25 years elapse from the beginning of retirement if you are invested in an evenly invested portfolio of stocks and bonds. There are a couple of problems with the 4% rule. One, 96% success means there is a 4% failure rate. 4 out of every 100 people are going to run out of money before they run out of life. That is not bad if you're in the group of 96. However, let's say you are leaving on vacation and the pilot of your flight tells you that there is a 96% chance that your plane will land without crashing. Are you getting on that plane? I'm not. Two, the 96% success rate can mean there is as little as $1 in the nest egg 25 years from retirement. In the capital equivalent value calculation, we are requiring the return of the $1 million investment at the life expectancy. Rather than 4%, most Americans will settle in somewhere between 3 and 4% as their acceptable distribution rate. Because at a 3% distribution rate, the probability of not running out of money is closer to 100%. For purposes in this book, we will distribute at 3.5%. The general capital equivalent value equation looks like this. Life insurance annual distribution divided by the distribution rate. So in this case, which would equal the capital equivalent value. So in this example, the capital equivalent value of life insurance policy, which is the $67,000 per year divided by 3.5%, equals $1,914,285. Therefore, any other investment, whether it be stocks, bonds, mutual funds, gold, silver, real estate, or any investment that might be invented, would need to accumulate to $1,914,285 in order to provide the same level of benefits as the life insurance. Capital equivalent value rate of return, the holy grail of investment gurus. I've always found it interesting that everyone wants the best return. When they say this, they always are talking about a rate of return, a percentage. However, when you fully understand the concept of allowing your money to compound forever while using someone else's money to spend, then the volume of money is more important than the rate of return. After all, at the end of life, when you reflect on everything you have accomplished, would you rather have had a higher rate of return or more money? So, for those who have a rate of return, ROR, to feel good about an investment, the only thing left is to calculate is the rate that is necessary for the alternative investment. That rate of return will represent what the investment has to earn in order to provide the same benefits as the life insurance contract. Building on the example in the last chapter, the capital equivalent value can be taken one step further. What would the alternative investment have to earn on an annual basis to accumulate the nest egg necessary to provide the same benefits of the hard to value investment? In this case, the permanent life insurance policy. This is the capital equivalent value rate of return. The calculation is fairly simple. 100,000 per year for 10 years must grow to 1,914,285, which is the capital equivalent value. The rate necessary to achieve that growth is 11.54%, which is the capital equivalent value rate of return. because the life insurance proceeds are tax exempt, the $67,000 from the alternative investment must also be tax exempt. This means that the capital equivalent must be grossed up for the taxes that would be due, and the capital equivalent rate of return must be recalculated for each tax bracket. Now, the author goes on to show income tax brackets of 15, 25, and 40%, and then show what that capital equivalent dollar amount needs to be and to offset those taxes. So now the 1,914,285 in each of these cases, and let's start with 15%, that capital equivalent value has to be 2,252,000. And that means that you, instead of getting 11.54% as a rate of return, you need to get over 14%. If the rate is 25, your tax rate is 25%, your capital equivalent value has to go from that 1.9 million to over 2.5 million, or your rate of return, in other words, has to be 16.55%. If you're in the 40% tax bracket, your 1.9 million has to now be almost $3.2 million, and the rate of return would have to be a little over 20%. What about investment fees? The values and rates of return above that were adjusted for the tax exempt nature of the permanent life insurance contract must be increased again if there are any investment fees associated with the alternative investment. So mutual funds, 401ks, all this stuff, there's all kinds of fees in there, and they can be anywhere from, a fraction of a percent to, 4%. And probably pretty consistent to be 1 to 2%. The values from the life insurance contract are from after all fees and expenses are paid. So we don't have to do that with the life insurance contract, because that was all built into getting that 67,000 a year. How often do these rates of return need to be realized? Can they fluctuate? So this at 15% tax bracket, at 14%, 25% tax bracket, 16%, and the 40% tax bracket over 20%. Can these rates of return fluctuate? Can we just use average rates of return over time? Well, I'm going to say, before I give you the answer in the book, the answer is no. These rates of return must be realized every year for 10 years without fail. Is that how the market moves? Is that how most investments move? You can't earn less of what is required one year and make it up the next. It won't work. Why? Assume an investment balance of $10,000 that grows 10% each year for 2 years. At the end of 2 years, you would have $12,100. If that same investment balance would grow at 5% one of the years and 15% the other, still a 10% average annual rate of return, the account balance would only be $12,075, so $25 less. And here's the key nugget. Any deviance from the average always results in less money. So we know that most of these investments, these alternative investments, do not move in exact rates of return year over year. There is a deviance. And anytime there's a deviance, he's saying there's going to be less money. So the rate must stay the same every year for 10 years without fail. Not going to happen. Life insurance trickle-down effect, Social Security. What are the unexpected benefits of tax-exempt withdrawals? Today, in general, 50% of your Social Security is taxable at the highest income tax bracket rate if your provisional income exceeds $25,000 if you are single and $32,000 if you are married. These numbers are slightly higher, I think 26 and maybe 26,000 for a single person and maybe 36 for a married couple. But let's just continue. Today, as much as 85% of your Social Security payments could be subject to this additional income tax at higher thresholds of provisional income. Provisional income is your gross income plus 50% of your gross Social Security payments plus your tax-free interest from the bank, so to speak. That's right. Your tax-free municipal bond interest may make your Social Security taxable. So much for tax-free. There is difference between tax-free and tax-exempt. We now see that anything tax-free is still reported to the U.S. government for tax purposes. In this case, to determine the taxability of your Social Security. What other tax-free investments are reported to the U.S. government for tax purposes? A distribution from your Roth IRA is reported on a 1099-R form, even though it is not taxable income. Will it ever be included as taxable income? Will it ever become part of the provisional income definition? We don't know, but it is being reported. To make what matters worse, haven't you already been taxed on your Social Security deposits when you were working? Of course you were. Our taxable income is determined when Social Security taxes are withheld. If they are taxed again when you receive the benefits, that would be double taxation. If members of Congress know about this double taxation, that means that your interests were represented when this second tax was enacted in 1984. We started a revolution in this country because we were being taxed once by the British government without representation. Now, this is double taxation with representation. Isn't it time you did something about this? You can live your retirement years without having reportable taxable or provisional income. What does this mean for the capital equivalent value in the capital equivalent value rate of return calculations? Today, in 2018, the maximum someone can receive in Social Security benefits at normal retirement age is $33,456 per year. The non-working marriage partner of that recipient would be entitled to a minimum of $16,728 per year for a total of $50,184. Although working spouses are entitled to 100% of their earned Social Security, which may exceed the 50% of a non-working spouse. One half of that 50,184 is what is automatically added to provisional income. That is $25,092. That doesn't even leave $7,000 from other sources before any Social Security is taxed. Meaning if your provisional income is $31,999, none of your Social Security is taxed. If your provisional income is $32,000, just $1 more, then your Social Security begins to be taxed. Up to 85% of Social Security is taxed for a married couple beginning at $44,000 of provisional income. That only leaves $18,908 for municipal bond income and distributions from your 401k. In IRAs, before the maximum percentage of Social Security is subjected to taxation. If 85% of Social Security is taxed, that will add $42,656. That is the 85% times the $50,184 of taxable income to these retirees' tax return. In the following brackets, that means this couple will be paying more income tax. For most who read this, this is likely something you didn't know. Again, he uses income tax brackets of 15%, 25, and 40. The additional tax that you're going to pay on the 15% tax bracket is just short of $6,400. At the 25% tax bracket, it's going to be an additional tax of $10,664, and at 40%, it's a little over $17,000. If you are retired for 25 years, which is age 66 to 90, you could have to pay the following taxes that you would not have paid if you had utilized the Internal Revenue Code to your advantage. So at the 15% tax bracket, he took that figure of about 6,400 and multiplies it times 25 years, and that's just short of 160,000. The 25% tax bracket, 25 years of additional taxes amount is 266,600. And if you're in the 40% tax bracket, there's an additional amount of taxes you're paying is 426,550. Now that you know the truth, how does that make you feel? Are you ready to do something about it? Because loan proceeds from a life insurance contract are not considered either taxable or provisional income, the life insurance distribution in the example 2 chapters earlier of 67,000 a year is tax exempt. It will not cause your Social Security to be taxable. If your life insurance distribution is able to keep you under the Social Security taxability thresholds, your life insurance has just added more money to your pocketbook, represented by the taxes you don't have to pay. To get a fair representation of what your life insurance contract is now worth, you have to recalculate the capital equivalent value and its rate of return. To determine the capital equivalent value and the capital equivalent value rate of return, while taking into account the tax effect of Social Security, you must add the additional tax to the required distribution from the alternative investment. If your alternative investment causes your Social Security to be taxable, you must withdraw the taxes due on the Social Security from the alternative investment cash flow to make the comparison to life insurance legitimate. The distribution from the alternative investment taking this into account is no longer the 67,000, but rather at the 15% tax bracket, it's just short of $73,400. 25%, it's 77,664, and at 40%, it is now 84,062. But now that the required distribution amounts are different, the capital equivalent value and the capital equivalent value rate of return have to be recalculated. Using the same calculation as described earlier, you're going to now need to get at 15%, you need 13% rate of return. At 25%, you need 14%. And at 40%, you need 15.49%. But remembering that life insurance proceeds are tax exempt, we need to adjust the cash equivalent, the capital equivalent, the capital equivalent value numbers because they need to reflect after-tax balance so that we can distribute an after-tax amount. And so the before-tax capital equivalent value on the 15% now needs, instead of being the 1.9, it now needs to be 2,467,000. At the 25% tax bracket, instead of the 1.9, it needs to be 2,958,000, or just short of 3 million. At the 40% tax bracket, that 1.9 equivalent now needs to be a little over $4 million. These values and rates of return must be increased if there are any investment fees associated with the alternative investment. So if it's in qualified plans or any of the stock market and those types of things, which isn't maybe the only place that you could have fees, but those are common ones, you've actually got to have even greater returns, meaning you have to have even greater amounts of capital to be equal to this life insurance policy. These rates of return must be realized every year for 10 years without fail. Remember, any deviance from the average will always result in less money. So these rates of return are now almost 16% at the 15% tax bracket, a little over 19% for the 25% tax bracket. If you're in the 40% tax bracket, we're talking about a rate of return of over 24%. And you got to do that every single year for 10 years without fail. Let's recap. You start with 100,000 per year to invest for 10 years, beginning at age 55. The permanent life insurance policy will make it spend as if it were 4 million after your accumulation period over your lifetime. Let's start with that again. Let's recap that again. You start with 100,000 per year to invest for 10 years, which of course is going to be 1 million. But the permanent life insurance policy will make it spend as if it were upwards to 4 million after your accumulation period over your lifetime. Has your financial advisor ever explained this to you before? Hopefully you now understand why an asset distribution plan is more important than an asset accumulation plan. What if you only had 80,000 per year to invest for 10 years? By focusing on asset distribution, you may have a more spendable cash flow in your retirement years than if you had invested 100,000 per year with the investments that are only focused on accumulation. Getting to the top of Mount Everest may not be in your best interest. Life insurance trickle-down effect, Medicare and other income-based benefits. Did you know that not everyone pays the same Medicare premium at age 65? The amount you pay is determined by your income, the 2 years before the current year that you become eligible. The more income you report on your income tax return, the more you pay for Medicare. Income refers to your 401k, your pension, your IRA distributions, up to 85% of your Social Security benefits, and any other taxable income you may have, plus your tax-exempt interest income. The federal government has not yet required that your Roth IRA distributions be included in your modified adjusted gross income. Everyone in 2018 paid at least $134 per month for Part B Medicare, but you could have been required to pay as much as $428 per month for the same set of benefits based on your income. That is potentially $3,528 more per year if your alternative investment is taxable. Since life insurance is tax exempt, that is another adjustment you must make to the cash equivalent value and the cash capital equivalent value rate of return calculations. What about other income-based benefits? They think of new ones every year. The more income you have, the less you get. If you don't have quote unquote income, then you get all of the benefits. Conclusion. In 2018, it is time for some new financial metrics. For as long as I can remember, and that has been 40 years as a CPA, financial professionals have depended on the same few financial measurements. A mainstay of these financial metrics is rate of return. In fact, many other financial measurements include rate of return as one of the measurement parameters or givens. But are these measurements enough to assess all the variables we are looking to measure? I'm going to skip a little bit. He gets into an analogy with baseball and all their analytics. In the financial world, the rate of return is typically only measured the return over a long period of time. But today, you now understand that financial accumulation years does not necessarily define the best financial distribution during retirement years. Success can not only be measured by simply calculating the rate of return over that entire period of time. We need new financial metrics for this task. Capital equivalent value and the capital equivalent value rate of return are the new financial metrics that achieve this calculation goal. It has taken 4 years to write this book, as it has grown from the inception of the idea in a small conference room at a hotel in Franklin, Tennessee, to what I hope becomes a new hallmark of financial success. Along the way, these ideas and calculations have been reviewed and challenged by countless financial professionals, until we determined we had true and accurate measurements. Capital equivalent value and capital equivalent rate of return are refining measurements of financial success, such as a baseball pitcher's walks and hits per inning pitched, or WHIP, further defines the effectiveness of a baseball pitcher beyond earned run average. Capital equivalent value and capital equivalent value rate of return give the ability to accurately determine value that was previously unable to be measured in the financial world. Let me say that again. Capital equivalent value and capital equivalent value rate of return give the ability to accurately determine value that was previously unable to be measured in the financial world. My hope is that this new understanding will give you further tools to achieve greater personal, professional success. About Bryan Bloom, CPA, author of The Capital Equivalent Value of Life. The Confessions of a CPA, The Capital Equivalent Value of Life Insurance. Bryan began his financial career immediately following earning his CPA credentials and bachelor's degree in accountancy from the University of Illinois. Later, he earned his master's degree in business administration from the University of Illinois Executive MBA program. His career started as a staff accountant for the State University's retirement system of Illinois, where he eventually became the chief financial officer. After 19 years of experience in the public retirement matters, he worked for 5 years with Benefit Planning Consultants, Incorporated, a third-party administration corporation overseeing private retirement plans. He is currently associated with the America Group and has been assisting individuals in their personal retirement planning for the last 18 years. Bryan earned $1 Million Roundtable membership within 4 months in the personal financial industry in 2000. He earned VIP of the Year award from Ohio National Financial Services that same year. In 2010, Bryan was recognized by Ohio National with their Chairman's Navigator Award, recognizing him for the personal integrity Bryan exhibits with his clients and business relationships. Bryan and his spouse of 36 years, Pam, live in Champaign, Illinois. They have 2 daughters, Callie and Corey, and 3 grandchildren, Emmy, Ellie, and Cohen. And that's it. I love this book. I think it's very simple. Please reach out to me if you have questions. You can reach me, John, at nashcashflow.com or 603-479-2511. Thank you. Hope you have a great day.